Hi everyone, welcome to my channel. I am Doris and I'm here to share with you about my stock account updates and also today's market. Today my account lost $1,825. The market does not believe the speeches of Fed officials, and the World Bank lowers economic growth. Let's take a look at my account. So currently my account made a total loss of $8,667.57, and that was an original net asset $100,000, and now it only has $92,513.89. Today I made a loss of $2,097 or negative 2.22%. Including the aftermarket price. Without the aftermarket price, it'll be $1,825. So why did my account lose today? I currently have SQQQ that sells short on Nasdaq Composite, and today it has made a loss of $1,742. And for DRB, it is a bear 3 times shares ETF of real estate. Today it made a loss of $355. And let's take a look at the market today. Out of all of them, the diagnostics and research ETF showed an increase of 3.82%, and the internet retail showed an increase of 2.52%. And then let's take a look at some market indexes. Dow Jones Industrial Average showed an increase of 0.56%, Nasdaq 1.01%, S&P 500 0.7%. Today the market showed a slight increase among all sectors. On Tuesday, market were still evaluating Fed officials' speeches about the outlook for interest rates. On Tuesday, Federal Reserve Chairman Jerome Powell said price stability was the foundation of a healthy economy. He said restoring price stability amid high inflation could require unpopular measures in the short term. Powell said the Fed must resist expanding its policy scope to address other important social issues. The Fed bears responsibility for climate-linked financial crisis. We are and will not be climate policymakers, and we will not use our tools to achieve other climate-based goals, Powell said. Powell did not comment on the U.S. economic outlook and monetary policy. Tudor Jones, a prominent hedge fund manager, described Powell's anti-inflation campaign as difficult, arguing that the Fed chairman faced the toughest economic environment in 40 years. Consumers have accumulated significant savings through the Pandemic Relief Act and other fiscal and monetary stimulus measures, he said. For Powell, how to scale back the stimulus without causing damage is very difficult. Heading into the new year, investors are still plagued by the same problem as last year. They still need to worry that the Fed's high interest rate policy could tip the U.S. economy into recession. Still, many seem to have become increasingly convinced that inflationary pressures in the United States have begun to decline. The World Bank on Tuesday lowered its global economic growth forecast for 2023 to 1.7% from 3% in June, the lowest pace in nearly 30 years. The bank said that due to the monetary tightening policies of the United States and Europe and the spillover impact of Russian-Ukrainian conflict, the outlook for the world economic growth is bleak. The World Bank expects U.S. GDP to grow by 0.5% in 2023, compared with a 2.2% forecast in June last year, the weakest non-recessionary performance since 1970. On Europe, Eurozone GDP is expected to be flat in 2023 due to soaring energy costs and rising borrowing costs, compared with a forecast of 1.9% growth in June last year, the World Bank said. The bank also expects investments in emerging markets and developing economies to grow at a 3.5% by 2024, half the rate of the past 20 years. Bank of America expects U.S. stocks to underperform global equities in 2023. Bank of America says that if U.S. investors do not avoid local provinces and diversify their stock investments into international markets, they may be hit by reality in the new year. Bank of America said it expects global equities to easily outperform U.S. stocks in 2023 after lagging behind U.S. stocks for 15 consecutive years. The bank believes that there are 7 major reasons why U.S. stocks will be outperformed by global stocks in 2023, including the end of negative yield bubble, the excessive exposure of the United States into technology stocks, the difficulty of stocks buybacks, the decline in energy prices, the shaking of global confidence in the dollar, and the risk of capital flow. This week, investors will be watching Thursday's CPI data and Friday's big bank earnings. The market now expects the U.S. CPI year-on-year increase in December to fall further to 6.5% from 7.1% in November, and the core CPI year-on-year increase will also fall to 5.7% from 6% in November. Investors hope that the inflation data will provide more support for the view that inflation has peaked and push the Fed to further slow the pace of its interest rate hikes. However, asset managers such as BlackRock, Fidelity, and Carmignac warn that the market is underestimating inflation and peak U.S. interest rates, as it did a year ago. A year ago, Wall Street almost unanimously underestimated the trajectory of inflation. After that, the Fed began a cycle of aggressive interest rate hikes to fight the worst inflation in decades, which wiped out $18 trillion in global stocks and the worst year in the history of the U.S. bond market. However, market now expects inflation to be relatively modest in 2023 and fall to the Fed's 2% target within a year, and the money markets are betting that the Fed will start cutting interest rates this year. Head of the cross-asset team and member of the investment team at French asset management giant Carmignac said labor shortages could lead to a higher than expected inflation, while underestimating inflation would put the market in a brutal situation again. Analysts at BlackRock Investment Institute also believe that high inflation will continue, and there is little to hope that recession will stimulate the Fed to cut interest rates. Julian Timmer, global head of macro at Fidelity Investments, also noted that inflation remains a significant risk to the market, as the Fed has repeatedly made clear that it wants to see inflation continue to fall to its 2% target, not just a slowdown in price growth. Credit Suisse stock analyst Zoltan Pozsar said in his latest research report titled War and Peace that era of economic war is not over yet. 2023 is no different, and he even expects the Fed to restart quantitative easing this summer. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.